Imagine this. You earned 47% profit in a year. You beat the S&P 500. Friends are asking you for investment advice. You feel like Warren Buffett. 8 months later, your portfolio is worth less than a bank savings account. And the down payment on a house, which you'd been saving for 3 years, has vanished. This is a true story for thousands of American investors in 2021 and 2022. They did everything right. They followed expert advice. They read smart books. They held their stocks. They bought more on the dips. And they lost money faster than they earned it at their day jobs. Why do correct strategies destroy portfolios? In the next 20 minutes, you will learn 3 things the investment industry prefers not to publicize. First, why the mantra "always stay in stocks" wasn't written for your benefit. Second, how market mathematics works against the emotions of the crowd. Third, what to do with your capital right now so you won't regret wasted time 5 years from now. Meet Michael, 52 years old, an engineer from Dallas. In 2020, he opened a brokerage account at Vanguard. He read the classics Bogle, Graham, Malkiel. He built a portfolio of index funds and blue-chip stocks. Simple strategy: buy and hold. Don't try to time the market. Time in the market is more important than timing the market. 2021. His portfolio grew by 34%. Michael feels like a genius. People congratulate him in the investment chat room. He buys more Tesla stock at its peak, $410 per share. 2022. The Nasdaq drops 33%. Michael's portfolio melts away. But he remembers the rule: don't sell during a downturn. He averages down, buys more at the lows. 2023. The market recovers. But Michael's portfolio is still in the red. His Tesla stock is bouncing around between $130 and $250 and will keep bouncing for another 2 years. His ARK Innovation Fund is still 68% below its peak in 2021, 5 years later. And the money he used to average down was frozen all that time. Michael did everything by the book. Why is the result a disaster? Here's what nobody says out loud. Investment textbooks are written by fund managers. And their business model depends on you never leaving the market. Every quarter, as long as your money is in the fund, they collect a fee. It doesn't matter if the portfolio goes up or down. Now guess which strategy will they promote? Stop. Let's break down the industry's main mantra. You can't time the market, so always hold stocks. Don't sell during a drop. Buy more on the dips. It sounds reasonable. Studies show, over the last 100 years, the S&P 500 grew on average by 10% per year. If you stayed in stocks the whole time, you got rich. But here's the question. Who conducted these studies? Vanguard, BlackRock, Fidelity, companies whose income is a percentage of assets under management. If you move to cash for 3 months, they lose their fee. If 1 million clients simultaneously pull out 20% of their portfolio, the company loses billions in assets under management. Their studies are technically honest, but they hide 2 facts. Fact number 1. The average return of 10% per year includes people who entered the market in 1982 at the bottom and held until 2000. But if you bought in December of 1999 at the peak of the dot-com bubble, you waited 12 years just to get back to even. 12 years your money just sat there, dead weight. Fact number 2. The industry equates selling stocks with exiting investments. But that's a false dichotomy. Selling stocks at the peak of euphoria and moving into treasury bonds yielding 4% per year is not exiting investments. It's capital preservation. And here's what's astonishing. Timing works, but not the way most people think. You don't need to guess the exact bottom or peak. You just need to identify the market phase, euphoria or panic. December 2021. Nasdaq at all-time highs. Investment subreddits are discussing when Tesla will hit $1,500. Cab drivers in New York are giving crypto advice. Your neighbor, who never cared about finance, is asking what stocks to buy. That's euphoria. Classic signal, it's time to reduce your stock allocation. March 2020. Pandemic. The S&P 500 drops 34% in a month. Headlines scream, Great Depression 2.0. People are closing accounts. Chat rooms are saying, "The market is dead for years." That's panic. Classic signal it's time to buy. You're not predicting the exact turning point. You're acting against the crowd when emotions hit an extreme. But to act against the crowd, you need cash. And if you're always 100% in stocks, you have no ammunition to buy during the panic. There's a mathematical way to make decisions without emotions. It's called the saw. Imagine the S&P 500 chart as a saw blade. The market moves in waves. Up correction, up correction. Most investors rebalance their portfolio once a year. On December 31st, they check their stock-to-bond ratio and adjust it back to the target. But the market doesn't live by the calendar. Alternative rebalancing based on standard deviations. Here's how it works. You set a target allocation. 60% stocks, 40% risk-free assets, treasury bonds, money market funds. When stocks rise by 15 to 20% from the last rebalancing point, you take some profits. You sell stocks, returning to 60-40. When stocks fall by 15 to 20%, you buy more. You sell bonds, returning to 60-40. It's a mechanical approach. No predictions. No emotions. You simply sell when it's expensive and buy when it's cheap. 2021. The market goes up 28%. You sell some stocks in December. You lock in profits. 2022. The market drops 18%. You buy more stocks during the sale. Result: you outperform 90% of investors who just sat and watched their portfolio melt away. It seems like elementary logic. But why do so few people do it? Because the industry convinced them. Timing is impossible. And now for the most painful part. The main cause of losses isn't ignorance. It's ego. You buy a company's stock. You do your analysis. You convince yourself. This is an undervalued asset. The market is wrong and you see the truth. The stock drops 20%. You think, temporary dip. The market will realize its mistake soon. It drops 40%. You average down. Now you have twice as many shares at a lower price. Your average purchase price has gone down. Feels like a smart move. It drops 60%. You hold. Because selling now would mean locking in a loss. And locking in a loss means admitting you were wrong. Your ego won't let you do it. You know what's most cynical? While you're sitting on that loss, paralyzed by your ego, your broker is still making money. Account service fees. Custodial fees. Fees for every averaging down trade you make in desperation. You're losing money. They're making money. Every quarter. Regardless of your results. The system works perfectly. But not for you. Real example. Peloton stock. Peak in January 2021. $167. Investors believed. The pandemic changed the fitness industry forever. March 2026. The stock is at $4. A 97% drop. 5 years. Thousands of investors held that stock for 5 years. Waiting to get back to even. Refusing to sell. Here's the absurdity. While your money is frozen in a falling stock, it's not working for you. You have $10,000 in Peloton. The stock drops 60%, you have $4,000 left. You hold, waiting for a recovery. But if you had sold at the minus 20% level, locked in a $2,000 loss, and moved the remaining $8,000 into an index fund, in 3 years you would have doubled your capital. Instead, you spend 5 years staring at your portfolio, hoping. This isn't investing. It's self-funded therapy. Next illusion. Social proof destroys portfolios. You open your broker's app. You see the Copy Trading Strategies section. Investor Maximus 2000 shows a return of 847% for the year. You think, if I copy his trades, I'll get the same result. You subscribe. 3 months later, your account is down 30%. What happened? Maximus 2000 made his 847% in a year. But here's what he won't mention in the strategy's promotion. Out of that 847% profit, he made 780% in 2 days. In March of 2020, he bought at the pandemic bottom using 10-to-1 leverage. 2 days out of 365. The other 363 days, his strategy returned 67%. Good, but not astronomical. You subscribed 400 days after the party was over. The market was already at its peak. Leverage was working against you, and now you're paying for his yacht with your deposits. This is how the system works. The broker shows the trader's return since inception. They don't warn you that 90% of those profits came from 1 month of extreme volatility. The average investor subscribes to a strategy at its peak popularity, meaning after all the easy money has already been made. And they pay for someone else's party with their own capital. Even worse are the chat rooms and forums. You read messages, made 120% on options. My portfolio doubled this quarter. Bought Tesla in 2019, now in the Maldives. Every message hits your ego. You compare your 8% annual return to someone else's 120%. You forget the main thing. Your goal isn't to beat a stranger on the internet. Your goal is to save for a down payment on a house, or to build a 6-month emergency fund. But the craving for social approval shifts your focus. You stop thinking about your real needs. You start chasing returns. You buy risky assets at their peak. You lose capital, and you move further away from your original goal. Now, about the self-deception that costs the most. Artificial intelligence in investing. 2025. Neural networks analyze financial reports, write summaries, predict trends. Many investors delegate their research to AI. Here's a real case. An investor asked ChatGPT to analyze a U.S. company, Alaskan Fisheries Incorporated, a small fish harvesting and processing business. The AI generated a convincing report. It talked about shipping fresh fish to China. It compared the company to its competitor, Northern Catch Corporation. It calculated potential profits. Only one problem. Northern Catch Corp is the old name for the same company, Alaskan Fisheries. The company rebranded 3 years ago. The artificial intelligence compared the company to itself and presented it as a competitive analysis. Shipping fresh fish to China? Fiction. The company only does local distribution. It sounded plausible. The numbers added up. But it was completely false. Here's the point. Artificial intelligence does the grunt work perfectly. It gathers data, structures information, finds patterns. But the final 10 to 20% of analysis requires a human. To verify facts, to assess management's motives, to understand hidden risks that aren't in the financial statements. The AI won't ask, why did the company's founder sell 80% of his shares last quarter? A human will ask, and that changes everything. The irony is that the secondary stock market is essentially speculation, redistributing money between participants. Real investing is an IPO, when a company goes public and gets capital directly to grow its business. Everything else, buying shares from another investor, is a bet that the price will go up and you'll sell it for more to a third participant. No real economy, just a game of guessing the crowd's mood. Realizing this changes your approach to risk. Now, the main thing, the thing that frees you from 90% of investment stress. Your capital is a single energy charge. It doesn't matter which assets it's in at any given moment. What matters is that it's working towards your goals. Most investors think in categories: my Apple stock, my bonds, my Tesla position. Emotional attachment forms. Tesla stock drops, you feel personal defeat. You hold a losing stock because you don't want to give up. That's a trap. The correct mental model, you have $100,000 of capital. Today, $60,000 is in stocks, $40,000 is in bonds. Tomorrow, the market goes up. You move $10,000 from stocks to bonds. The capital is the same. The form just changed. No drama. No regrets. Tesla stock dropped 50%? You sell without emotion. Because it's not your Tesla. It's just $5,000 of your capital that would now be more useful elsewhere. This mental model gives you freedom to act. You stop marrying assets. You manage capital flexibly like a chess player moving pieces. Next truth. Cash is not dead weight. It's optionality. March 2020. The market crashed 34% in 3 weeks. Amazon stock was trading around $1,700. If you had 30% of your portfolio in cash, you could buy Amazon at a fire sale price. By year's end, the stock was worth $3,200. Your profit, 88% in 9 months. If you were 100% in stocks, you had no money to buy. You just watched your portfolio fall. Cash gives you the ability to act. The paradox that financial advisors don't mention. Warren Buffett, the most successful investor in history. Before stepping down as CEO in January 2026, he raised Berkshire Hathaway's cash to an all-time record, $373 billion, in cash and short-term treasury bonds, more than the company's entire stock portfolio. The man who got rich on stocks was selling them for 12 consecutive quarters. 3 years of net selling. He sold Apple, reduced Bank of America, hoarded cash. Why? Because the market is overheated. Because there are no good opportunities at reasonable prices. He didn't hand his successor, Greg Abel, an aggressive stock portfolio. He handed him a fortress of cash, so they'd have something to buy with when the market finally crashes. But financial advisors tell retail clients, stay in the market 100%. Always. Timing doesn't work. Coincidence? Or a conflict of interest? In moments of euphoria, cash protects you from overvalued assets. In moments of panic, it lets you buy quality companies at huge discounts. How much cash to hold? It depends on the market phase. Market at all-time highs, the VIX Fear Index below 15. Everyone around you is talking stocks. Hold 30 to 40% in risk-free assets. Market drops 20 to 30%. Panic in the media, people closing accounts. Reduce cash to 10 to 20%. Buy more stocks. This isn't guessing. It's reacting to objective crowd signals. And one last thing, a philosophical context. We live in an age of abundance. Humanity has solved the main problems of survival. In the US, food is available 24/7. Communication is instant. Knowledge is free. Entertainment is endless. The main problems of modern people are artificial, created by boredom and the craving for dopamine. The fear of missing out on a 30% stock market rally in a year, that's not a survival problem. That's an ego game. If your basic life is secure, stable job, paid for housing, decent health, investments should be boring. Buy an index fund. Put money in a high-yield savings account. Hold treasury bonds. 6 to 8% annual return. No stress. No middle-of-the-night price checks. In 20 years, your capital triples. You fund your kids' education. You retire with a safety net. It's not an epic success story for an investment chat room, but it's a real result that accomplishes your life goals. The thrill, the chase for Chalgal returns, the comparison with other people's portfolios, it's all entertainment. Expensive entertainment that usually ends in losses. The main question isn't, how do I make 100% a year? It's, how much do I need for a comfortable life? And how do I get that with minimal risk? Answer that question honestly, and you'll free up 90% of your mental space. So, what to do right now? First, write down the goal action link. If your goal is to save for a house down payment in 3 years, don't buy small cap stocks. Use short-term treasury bonds or high-yield savings accounts. If your goal is retirement capital in 20 years, build a portfolio, 70% index funds, 30% bonds. Rebalance once a year. Second, do an emotion-free portfolio review. Got a stock that's down 40% and hasn't recovered in 2 years? Ask yourself, if I had the cash right now, would I buy this stock at today's price? If the answer is no, sell it immediately. Free up capital for assets that actually work. Third, maintain the optionality of cash. Always keep at least 20% of your portfolio in liquid, risk-free instruments. Money market funds, short-term treasury bonds, high-yield savings accounts. Cash is ammunition for buying during a fire sale. Fourth, practice information hygiene. Leave the investment chat rooms. Delete apps with stock price notifications. Check your portfolio once a month, no more. Your main source of capital growth isn't the stock market. It's your main job, your skills, your career. Focus on what you can control. Remember Michael, the engineer from Dallas? He spent 4 years on a portfolio that went nowhere. For years of stress, worry, hoping for a recovery. If, in December 2021, he had simply locked in his profits, moved 40% into treasury bonds yielding 4%, and waited for the correction, his capital would be 30% higher right now. And more importantly, his nervous system would be intact. Investing is not a sport. It's not a competition for returns with strangers on the internet. It's a tool for solving specific life tasks, buying a house, funding education, a comfortable retirement. The more boring your strategy, the higher the probability that in 10 years you'll reach your goal. The market rewards patience, punishes greed, and it is merciless to ego. The only question is, what game are you playing? If it's your game, then it's time to turn off the news, close the chat rooms, and focus on what actually works. Write in the comments, what is your main financial goal for the next 5 years? Not a percentage return. A real, measurable goal. If this breakdown saved you even one stressful evening of checking stock quotes, hit the like button. And subscribe if you want more analysis without the manipulation and marketing fluff. Thanks for watching. Good luck with your investments. May they be boring and profitable.